Hello, everyone. Thank you so much for joining this week's edition of Virtual Office Hours. We have a really interesting conversation today around asset classes, the stocks, whether it be MMFs, whether it be real estate. We are diving into all of those different things, and we'll be exploring all of those with you today. We have some very exciting guests with us here to dive into the sector. But before we get started, let's give everyone a minute to join the room. So I'll pop the countdown on the screen, and then we'll get started. But see you in a minute. Hello and good evening, everyone. Thank you so much again for joining us on this week's edition of Virtual Office Hours. We have a very insightful conversation, as I mentioned earlier, around asset classes, comparing different things. What do they mean when it comes to risk? What do they mean when it comes to, different geopolitical actions? What does this mean, when comparing? And where do you start? That's the important thing. If you have, 1,000 shillings in your pocket, where do you start? Oftentimes it can be overwhelming to start investing because you have so many different options. So hopefully today we can shed some light on that for you. Now, I do want to let you know that we are live currently across not only on our webinar platform, but also live on the Kenyan Wall Street YouTube page, Kenyan Wall Street LinkedIn, and the Kenyan Wall Street X account. If you have any questions throughout this entire discussion, we'll try to leave a few minutes at the end to address Q&A. Now, if you have questions, please include those in the comment section, no matter where you're watching this webinar, because we can see them all from our end, and we'll be sure to pop a few really good questions up on the screen and address those directly. But in getting started, Solomon, would you like to introduce yourself, introduce Vida, and give us an interesting fact about yourself?
Okay, thank you very much. My name is Solomon Nzomo. Work for Vida. I'm the Chief Financial Officer. Vida is basically a residential developer that plays in the affordable to the mid-market space. Our flagship projects are currently at Garden City and growing to other locations. Our other project that will actually be completing soon is called Keza, located in Jujuta, and we are launching a few more. Guess that's for an introduction. An interesting fact about me. What comes to mind right now is generally I'm an active person. I'm a cyclist. Before my knees decided to give up on me, longest ride 185 kilometers.
185 kilometers. Oh my gosh, I don't want to go that far in a car. Bansri, would you like to introduce yourself, introduce AIB-AXYS, and give us an interesting fact about you?
Absolutely, absolutely, Andrew. And good evening to everyone present today. Very excited to be part of a conversation talking about money markets, real estate, and of course, all the other investment opportunities in our market today. So, my name is Bansri Pattni, and I'm currently the Chief Executive at AIB-AXYS Africa, which is one of the leading stock brokerages in Kenya, probably actually the largest retail broker from a local and foreign perspective. And under our institution, we trade equities, fixed income, derivatives. Most recently we've offered offshore products to all our clientele. And of course, we are part of the larger Axis Group based out of Mauritius, and that means I'm then also able to offer, all sorts of funds to my clients as well. So just allowing our clients to have a very resilient and a very diversified portfolio. All right, so I think that does for an introduction. And in terms of an interesting fact, okay, that one you've got me off guard, but Andrew, just say probably I love traveling. I've tried to cover most of Europe, and probably in the next 5 years, I hope to cover larger bits of Asia as well.
Oh,
Yes.
exciting. So perfect. And we have someone else who's planning on joining us on the panel, George from Britam, but I think we are just waiting for him to join us. So when he joins, I'll have him introduce himself and Britam Asset Managers. But in the meantime, we get started and we move forward. So my first question, and I'd like each of you to address this, is around how do you describe different asset classes, whether it be real estate, stocks, bonds, money markets, and such, to someone who doesn't care for all the financial jargon? Solomon, should we start with you?
Sure, no problem. I would say it all forms part of what we will call a portfolio. And it's part of your wealth building and creation. And it's not enough to create the wealth, then you have to sustain it for the longer haul. And hence why there are those different asset classes that take care of different aspects of your portfolio, and also supporting your lifestyle, depending on where you want to go and which age you're at. So most people, the natural thing to do is set up a portfolio that takes care of you in your old age, and you're also able to pass on the good work that you've done to the next generation so that they're not starting from zero. And therefore that tends to influence how you play around with all these asset classes. Even in a less informal sector, that's what everybody tends to do. Even if you're putting money in a bank or land banking or doing whatever it is, that tends to be the reason why you're doing this. So I will explain those categories.
Thank you. Bansri, how do you explain to a new investor, someone who has never invested in anything, the difference between these asset classes and how they relate to each other?
Excellent. Thanks, Andrew, for the question. So in terms of the different asset classes, what we've found ourselves doing with different sort of clientele is to take some time to first and foremost understand the risk appetite of clients. What are they looking for from an underlying nature of investments? For example, some clients are looking for liquidity, some are looking more for a long-term view where they're not considering factors like immediate returns. So I think we sort of compare what our investors would like and probably what their preference is vis-a-vis all the different kinds of products that we have, whether it's equities, bonds, derivatives, and we're able to then match their sort of needs against what the different assets offer as underlying benefits. And that sort of then helps us to also explain to them why a certain product fits them and to go into sort of the different depths of why the product, how the product has been performing and why it sort of meets what they're looking for. So I think that has worked really, really well for us. And I think the starting point is always first to understand what does the client want, what are their needs, and then matching it against the underlying nature of the different assets, the different sort of investments that we offer here.
Awesome. Yeah. So, George, can you hear us? Can you see us?
Hi, good evening, everyone. Yes, I can hear you. I can see you. Sorry, I joined a bit late, a bit of a technical hitch.
It's all good. It's all good. You know, we live in the digital age, but we're still owned by it. So tell me, George, sorry to throw you on the spot so quickly, but tell us who you are, what you do with Britam, and then one interesting fact about you.
Okay, thank you. So my name is George Njung'e. I'm Senior Portfolio Manager at Britam Asset Managers. So Britam Asset Managers is, of course, part of Britam Group, which is one of the most well-known brands in this region in terms of financial institutions. Actually, Britam is turning 60 this year. Britam Asset Managers, again, is one of the longest serving asset management companies, has been in this market for over 20 years and has since spread out to other regions, Uganda and so on. So in terms of what we do, we just provide investment solutions for all categories of clients. So we provide investment solutions for individuals. This is mainly through our retail products, unit trust funds such as the money market fund, bond plus fund. We have equity funds, and recently we also added the money market USD fund and the dollar fixed income fund to our stable of funds, and these are doing quite well. I think it's been an area in the market which people have shown a lot of interest. So apart from these retail products, we of course offer pension products. So if you own a small SME or an MSME, and you want to be compliant with the government retirement rules, we have an umbrella fund which makes it very easy for you to be able to get retirement coverage, to get your employees retirement coverage. So, and apart from just being compliant with government rules, it's also very important from the perspective of reducing old age dependency. You don't want to be relying on your kids, on your relatives past retirement age. So other products we do have what you can call discretionary funds. So if you are a very high net worth client, you're an institution who wants your funds invested professionally in a certain way, then you can talk to us. We also offer property. We have a full-fledged property section, and these allows us to offer advisory, to be able to work with you every step of the way. So that in brief is Britam Asset Managers. I lead the investment team within Britam Asset Managers. And because of how well we've done for our clients, over those more than 20 years, we are currently managing assets in excess of 200 billion Kenya shillings.
Awesome. Now, the whole essence of today's conversation is around various asset classes, as I mentioned. So if you have any questions, please, we'll address them at the end. Everyone listening, you can add them into the comments wherever you're watching. Now, Solomon, I want to hop back over to you. Now, real estate is a very key kind of asset class within having a diversified investment portfolio. So I'm curious, from your standpoint, because everyone's always asking, hey, hey, Andrew, hey, Vida, how is real estate doing? How has it done in the past few years? So I'm curious, for you, how has real estate performed over the past few years compared to, other asset classes and such?
Okay, thanks, Andrew. There are different segments within real estate. So those who will be playing in the commercial space, that's offices, malls, and such kind of things. Then there's the logistics side and the residential side. So I'll speak more about the residential side of things. And the residential element of real estate tends to be very resilient, because at the end of the day, regardless of how bad the economy is, how good things are, people still need shelter over their heads every other day, and security for their families. And it's also a very cultural thing for us, particularly, who to always want to either own the piece of land where I reside or to own the roof above my head. So it tends to be extremely resilient. And because of that, over the last, call it 5 to 10 years, the returns have been very predictable. When you look at, so there are two elements of returns when you come to real estate. This is what you call the rental yield. And that's basically what you're just making every other month from the rent that you're collecting as a percentage of the total value of that asset. And that tends to vary between 6 all the way to 10, 11, at best 12%. And that tends to be very inflation hedged, in the sense that as the cost of living is increasing, every subsequent tenant that you get, you always tend to adjust that rent upwards. And all of us have experienced that in the different places that we've lived in. Then the other one is just pure capital appreciation, because the number of goods from a supply side, good real estate opportunities in very well master planned developments or parcels of land close to infrastructure or key nodes, there's always a kind of a shortage. Therefore, there's always that appreciation that comes from that. But then there's also just the general appreciation that tends to happen over time. And what we've observed is it will range between an average of 5 all the way to 12 or 13%, depending on the region that you are at. So over time, you will see the total return. If you add up those two elements, you are playing in the regions of 11 to 20% from a total return perspective. So that comes with that. Not like a downside per se is that real estate then tends not to be very liquid compared to money markets, which my colleague will speak to. And therefore, if you're going to real estate, then it all tends to be a long-term game, where you are going there with an aim of building a certain portfolio with a very steady cash flow that when you combine with your money market, with your bonds, with your equities, then there's a lot of predictability, and you're able to remove the noise from the portfolio, so that when things go south, like there's about to be war in Iran, you're not worried about what happens to your portfolio in overall. So it plays that very critical role of diversifying and reducing the volatility in your portfolio when you look at it in overall.
Okay, interesting. Now, Solomon, would you agree with me that, of many of the investment vehicles and asset classes we're discussing today, real estate probably has the higher barrier to entry, as in you tend to have a bit more cash to get into the space?
It used to be a few years ago. Then some brilliant Kenyans came up with the whole off-plan kind of purchase scheme, which allows you a longer payment plan and therefore reduces that barrier to entry, in as much as there has been issues, as would be expected in any developing market, reputational or otherwise, that has been there, because it has also happened in other sectors. In banking, we've seen banks come down. In stock brokerage, we've seen brokerages that have also gone on. So it's a common thing. So in real estate, for us particularly, it's an off-plan kind of purchase mechanism. What that does, it gives you 24 to 30 months for you to pay. And with our affordable housing, our lowest priced unit is roughly 2.5 million, which is a studio apartment, going all the way to the most priced, around 17, 18 million at the moment. So you're playing around with a very huge segment of the market. And you have a very long payment plan to be able to make your payments. So the monthly payments or quarterly payments are not are in small bites that anyone who has decided to invest in real estate is able to choose. So for 50K, 100K, 200K per month, you're able to purchase your unit. Then towards the end or at the end when the unit is done with the government's KMRC program, means then somebody is able to take up a mortgage at a very low interest rate and complete. So it depends. So that barrier to entry from a ticket size perspective has in one way or another been addressed.
Okay, awesome. Now I want to, ask the next question to Bansri, and then I'll move over to George on this same topic. When we were preparing for this webinar, our audience at the Kenya Wall Street was like, you have to talk about money market funds. You have to talk about this because, we have seen considerable growth in the space over the years. And, oftentimes I don't think people know what is in a money market fund to start, or how safe they are. So Bansri, question for you, money market funds, what are your thoughts, and while people often consider them safe, I guess I'll throw the tough question, how safe are they really?
All right, thanks, Andrew. So I'll start with, of course, what is a money market fund? And so ideally, it's a fund that is managed by fund managers in our market who are licensed by the Capital Markets Authority to handle investor funds. And typically, these funds invest in what we call interest-bearing instruments. So these include the typical government securities. We're talking about fixed deposits by banks. We're looking at private or even public commercial papers. So what you'd also notice is that generally the kind of instruments that money market funds invest in are instruments that don't have tenures of more than 13 months. So that then also introduces the element of liquidity. So this allows money market funds to offer much more liquidity to investors. And and at the same time, giving us a steady and sort of a consistent flow of income. And as we've seen, I think this has, by the fact that the underlying instruments are, as I've stated, we've seen so much of interest coming down to this. I think in the recent past, it's probably been the most popular unit trust product. It's about 65% of assets under management are currently under money market funds. We saw a surge of close to 80% in January this year, looking at client interest and sort of the kind of money that was coming through. And this also shows the rising interest and awareness of clients of what's inside the money market funds. The number of licensed fund managers is almost crossing 55. And on a quarter-on-quarter basis, we are seeing a growth of about 30% in money market funds. So definitely, this is possibly because a lot of investors are also looking at it as a safer option. The barriers to entry are probably much lower than real estate. We can start off as low as 1,000, 2,500, going all the way up to what an investor is able to pay for the money market. And you are also able to withdraw funds as and when you need. So in terms of safe, I think a lot, in terms of how safe the money market fund is as an investment asset, I think a lot of investors are comforted by the fact that the underlying is probably a government security. In most of the money market funds, you'd find a large asset allocation given to government securities, and touch wood, we've not seen our government default so far. So that has given a lot of, comfort element to investors in terms of, again, fixed deposits, knowing how regulated the banking industry is, and with very few defaults in the past. Again, that has given a lot of comfort. And also just the fact that it gives you consistent, predictable, long-term returns is the side of this investment sort of class that a lot of investors have been looking for, in the midst of all these political and economic changes that we are seeing. So I think collectively this is what has contributed to the safety of the product.
Okay, interesting. And I'm curious on the AIB-AXYS side. So, as a stockbroker and such, you're also allowing people, it's not just buying into a fund, they also can choose their own portfolio, correct?
Absolutely. So for AIB-AXYS, we are not directly fund managers, but we do distribute funds through my parent company in Mauritius. And of course, we have different types of funds. Like Solomon had also mentioned, he has a Kenya shilling fund, a USD fund. Of course, we have very different funds in terms of global exposure, local exposure, Pan-African wide exposure. So investors are looking for very many different things. I don't think it's just a conversation of returns anymore. It's also looking at how safe, how diversified, how resilient the portfolios are in terms of what's being managed as underlying assets in the fund. So the conversation is dynamically changing globally as well, and we're seeing the ripple effects in Kenya too. So again, it all just depends on what the investor is looking for, but I'm just trying to highlight that the trends are moving from just looking at a return perspective right now.
Okay, interesting. I know, when I started my investment journey, the day I turned 18, I was living in the US at the time. I signed up, I was like, I'm going to start trading on the stock market. And it took me several years before I got the money back that I put in on my 18th birthday because I thought I was smarter than everyone else. And one of the things I learned was that, many of these ETFs and fund managers, they can do the hard work for you sometimes.
Yeah, absolutely.
Yeah. So, George, I want to come back over to you now. So, in your introduction, you took us through a whole host of different products and things that Britam Asset Managers offers. And I'm curious, when someone comes to you and starts investing, how do you advise them in regards to diversification and such? Of course, you don't want everyone putting everything into one thing. This is what we've been talking about the whole time. So I'm curious your insight on diversification, and what different products, people often look for. And I guess, whether or not Britam has a money market fund. I'm curious on that as well.
Thanks for that question. So starting with the last one, yes, we do have a money market fund, doing quite well. I think it's one of the longest serving money market funds in the market, and I think currently one of the top yielding money market funds as well. So we do have several investment options, as I'd said, and I think you've rightly you captured that there has been a very high interest in these money market funds, especially, let's say, over the last 12 months. There's been a lot of movement towards this. We have noted, with a lot of appreciation that nowadays, even some of these morning shows, you will just hear people calling in to discuss investment options. Money markets are usually top of the list, and I think it's one of the better discussion topics that you can have in some of these morning shows. So given that we do have a huge variety of investment products, then when a client approaches us, then it's very important for us to be able to understand the client and for the client to be able to understand the various investment products. What is important is, one, for the client to really appreciate what is their objective, what is it they are actually looking for, and especially in terms of investments, then, do you have a certain time horizon? So do you want to invest for 6 months? Do you want to accumulate, funds for certain projects? So that's one of the very key things we look at. Secondly, we also look at your ability and willingness to take risk. And if you allow me, maybe let me just first pause here to define what is risk, because this is a word which is used very often in the market. But unless you are very conversant with investments, you'll find that two people are using the same word, but talking about two different things. So from my perspective as an investment professional, then investment risk is how variable your level of returns will be in a certain investment product. So let me give you an example. If today you took 100 random people and you gave each of them 100,000 shillings and you told them, go invest in money market funds. After 1 year, if all of them came back, what would be the level of variability in terms of their returns? Would all their returns be positive? Would some of them have performed much better than others, and so on? So if there's a low level of variability, then it means that that investment product has low level of risk, because you can confidently say that if I also invest in it, then I'm reasonably sure of getting these kind of returns. So if again you took the same 100 people, gave them 1 million each, then you told them invest in all these other products, how variable would their returns be? If you told all of them to, for argument's sake, open hardware shops, would some of them go bust within a short period of time? Would some of them do very well, and so on? Then, if there's a very high level of variability in how these 100 random people would do when investing in hardware shops, then we can say that hardware shops has a certain level of risk. The variability is high, then it has a high level of risk. So it's very important for people to understand what is investment risk, and once you understand that, then how much risk are you able to take? How much risk are you willing to take? There's usually this perception that there's a high correlation between investment risk and investment return, and some of our potential clients will then come and say, give me your highest risk product because I really, really want to get high levels of returns. But you see, it doesn't work that way, because if you take a product which is high risk, meaning it has a high level of variability in the returns you're likely to get, it means you can either do very well, but conversely, you can also do very poorly. So once the client comes, then we'll understand what is your objective, what is your time horizon, what is your ability and willingness to take risk. And now we can also then be able to look at other factors. Do you need, constant liquidity levels in between your investment horizon? Do you have concerns on things like, taxes and so on and so forth? So all these factors, once we have a meeting of the minds and alignment with the client, then we are either able to direct them to our existing products. We can be able to give them, the detailed definition of the products and so on. But for some of our high net worth clients, our corporate clients, someone who wants a customized product, then again, you can still sit down, come up with an investment policy statement, and be able to customize an investment product for you.
Okay, interesting. Now, Solomon, I want to come back to you on the topic of diversification within real estate. So earlier you had mentioned, hey, we have, really three different types of real estate. You have even four. You have land, you have industrial, you have commercial, you have residential. So I'm curious, since COVID, and everything, have you seen that, there are people, because I know there are people who own 20, 30, 40 apartments, across Nairobi in different neighborhoods. Are you finding that people are, using different things such as, hey, these 10 apartments are Airbnbs, these 10 apartments are long-term rentals? I'm curious from your standpoint, are you seeing people are diversifying their real estate portfolios that way, in the same kind of, in the same spirit of what we're discussing in regard to, the markets?
Yeah, correct. And we observe that especially among most of our buyers who tend to be investors. And what they're really doing is just diversifying their portfolios. But because if I decide to put up a single apartment somewhere in Nairobi, the capital outlay is quite significant to pull that off. So maybe 200, 300 million, which is a lot of money to put up at a go. So we see people, what they're doing within real estate, they are diversifying geographically. So I will have 3 units at Garden City, I'll have 2 at Westlands, I'll have 5 at Keza, 2 in a different location, and also all those apartments are speaking to a different market segment. Now, Nairobi is a largely tenant market. Roughly close to 80% of the people in Nairobi don't own the houses that they live in. So they are willing to move houses every other time. So getting a tenant is never an issue. So this kind of investors, what they're doing, they're building their real estate portfolio, but they're also diversifying it geographically to get exposure to different segments of the market. So you find, yes, the overall portfolio, the entire real estate as a whole is diversified, but also their portfolio overall is also very well diversified. So we've seen that quite a lot. And every time we launch a new product in a different location that's different from one and the other, depending on which segment it's playing at, we find a lot of repeat buyers who tend to move with us on each and every project that we are rolling out.
Okay, interesting. Yeah, because I've seen that. Like I said, I know of people who are really focusing on, investing in different, not only geographies. You can also, George had mentioned, and Bansri, there's USD investments, there's Kenyan shilling investments, all different ways to kind of hedge your portfolio. And different types of diversification as well, because at the end of the day, you want to, build your house on rock, not on sand. And I think that's an important, analogy to kind of get into this. Now, I want to come back to Bansri real quick. So I guess for you personally, working in this space, working in the sector, when you started your own investment journey, what were some of the first products that you looked at and engaged with?
Great, thanks. Thanks, Andrew. You're just taking me back in the day, and I can tell you, of course, one of the products that I chose when I did start out, of course, was highly dependent on the money that I had at that point. Of course, not being a very heavy investor, it meant that I'm looking for products that are probably a little bit pocket friendly, and that if you look at our market, would probably fall in the equities market segment. And of course, we also have the fixed income bonds, but with the fixed income bonds, you're looking for a minimum 50,000 Kenya shillings to start off your journey. So it was way easier to start off in the equities space, with just a small ticket size of 100 units of whichever share that you bought at that given point. And with that low cost, with that low barrier to entry, it meant that I was able to buy shares that I, of course, at that point had strong fundamentals. And yes, so that's, I believe, investing in the equities market is what gave me confidence. It allowed me to venture into a space. Of course, that also then means with probably a risk appetite like mine, which is a bit low, that allowed me to dip my toes into a space that I wasn't too sure how it would work. And so even if it went south, I would still be okay. I've not lost too much money as well. And with how our markets were at that point, it was quite stable as well. So eventually, of course, the portfolio grows with time. It gives you more confidence, and that then allows you to start looking at slightly larger investments that are a little bit more capital intensive. And not only that, probably allows you to, with the confidence that you've built, you can start looking at a slightly more riskier instruments as well. Yes.
Okay. I'm with you. Like I said, I started in the equities market. Definitely
Yes.
lost money in the equities market too, but learned a lot of valuable lessons that I can
Right.
carry with myself.
Absolutely.
30% of your portfolio in Tesla is not it can be risky, You're hedging all of your bets on Elon Musk's tweets.
Correct. And I think, Andrew, what's coming out a little bit more importantly right now is that I think for investors who are looking for, some good level of return, I think we're now starting to see a trend in investors having a long-term perspective versus investors who are coming in with very short-term perspectives looking for long-term returns. It's just not going to add up. So it's very important for investors who are looking at creating wealth or looking for a steady, sort of consistent source of income to have that temperament that allows them to sort of view investments and returns in the longer run, because the market itself is not really built for short-term investors, if you put it that way. Because if you really want to see gains, it's a slow game. It's a slow game unless you're looking at probably individual asset classes like fixed incomes that you have a predictable flow every 6 months or every year. But with equities, of course, we've seen them surpass as early as this year. I think they've outstripped the performance of most of the other asset classes at about 19% year to date. Last year, they were at about 34% in terms of growth in valuations. So I think it's not talked about enough, but the equities market space is doing probably phenomenally well. And I think it's also just the risk attached to it that probably draws away a lot of investors. But I think for investors that are ready to to step into a slightly risky zone, the equities space is probably the starting space. But again, you don't have to invest so much money and be discouraged by probably losing also. So it's maybe starting out small, having a long-term perspective, and then growing your investment with time. Probably that's what we've been advising all the retail clients we have, whether young, most of them, of course, young. So knowing that they have a longer investment horizon with us as well.
Yeah, I think the horizon is really important in the timeline. Because correct me if I'm wrong, but I don't think Warren Buffett became a billionaire until his 70s.
Absolutely. And we use that example a lot as well. So it's just very key for individuals to appreciate that this is a patient game. It's not money overnight. Right.
Okay.
Yeah.
Now, George, I want to come to you with the same question. But knowing what you know now, if you were starting out again, at 22, 23 years old, where would you look to start your investment journey?
Okay. Thanks for that question. So I'm hoping you're saying I'm 22 years, but I have the net worth that I have now. Okay, anyway, so the biggest constraints, of course, when you're a bit younger, would be the amount of disposable income that you have to invest. That is one. However, the wisdom of hindsight, one of the things at least I had in my younger days, was that sort of impatience and maybe that approach where you're saying you're just looking for that one big deal which would, move the needle significantly. But as you rightly pointed out, Warren Buffett, who is, I think, the most famous investor, didn't become a billionaire until he was well in his 70s. And I think he started investing in his teens or his 20s. So if there's one lesson that people should be able to learn, is that slow and steady wins the game. Don't go and look at and try to look out for that one big deal which will double your money, because experience shows you that instead of doubling your money within a short period of time, what you're likely to do is get your fingers burnt. So if we were to go back and probably look at what is considered to be a relatively safe investment choice, which would be fixed income. If you are to look at, let's say, the T-bills or the treasury bonds as an indicator of the kind of return you would get. If you are religiously investing, let's say, in T-bills and T-bonds, and then on top of that, you layer a bit of knowledge about being able to go a bit long term when you see that rates have really risen, and then you move your investments towards the short term when you see interest rates have come down. To give an example, barely 12 months ago, I think bond yields had really risen to very high levels. If you look at bond yields at the beginning of 2024, they were really high. And as a smart investor, then that would have been the time to lock in those high yields for a relatively longer term bond. And then, 6-12 months down the line, when you see yields have declined somewhat, then you can be able to sell that bond, realize all those gains, which will be significant, and then you invest in relatively shorter term bonds or treasury bills, and then wait for the next cycle. If anyone had done this religiously over the last 10 and 20 years, then they would be speaking about very high multiples of their wealth. But to do this, you need to have a level of patience, a level of discipline, and also that bit of knowledge to know when is the best time, to go for a 5-year bond, when is the best time to go to, let's say, if you're investing in unit trust funds, to go into the fixed income or bond plus fund, and when is the best time to go to the relatively shorter term money market fund. People say that compounded interest is the eighth wonder of the world, and that is true. So starting off, you'd be saying like, you're just getting a return of 10%, 11, 12%, and that may not seem to be very high, especially if you're getting, a lot of feedback about someone who made it big in Bitcoin and so on. But if you are consistent and you are getting those returns, you are being able to ride the wave where, let's say, for instance, last year, money market and bond plus rates had really spiked, then over time, if you looked at the multiple of your wealth, this would be quite significant, and it would be even more than someone who had gone to the more spectacular investment, if I can call them that way. So it is never too late to start. So for all intents and purposes, Andrew, you are 22. So whatever you would have
Wow.
done back
I'm
in
not
the day,
22, but I wish. I
whatever,
wish.
what, whatever you would have done when you were back in 22 years of age, you can still do it now. Famously, the founder of KFC, I think, didn't start out until he was in his 60s. So
Yeah.
if at this point in time, it will be even much easier to have that level of patience, that level of discipline, and of course, you've already gained that information. Then, if you started accumulating your money and making sure your money is working as hard for you as you're working for it, then your horizon, let's say 5, 10, 15 years, you'll be talking about very high multiples of your wealth.
Okay. Now, very interesting thing that you mentioned was compounding interest. So if you guys don't know what that is, everyone listening, it's probably one of the best things in the world in regards to wealth building. But when it comes to compounding, it's about time. And, back to Warren Buffett again, he talks about this all the time. And he has a very, very diversified portfolio, so being patient, because one of the things that I know I've seen from hearing so many stories from people, here in Kenya, is that when they get their dividends, they go out and they spend them, they party with them. One of the things I think is really interesting, and what I think the smartest investors do, is they take those dividends and throw them right back in. They say, all right, now time to buy more, and such. So I think, that's just some small ways you can utilize compounding interest to your advantage. Now, Solomon, I want to come back to you and ask you the same question. Now, we've been talking for quite a while, so I wanted to let you guys know that here in a few minutes, we'll start the Q&A. So if you have any questions, please throw them in the comments. But Solomon, if you were, let's continue with 22. If you were 22 years old again, but you know what you know today, where would you be looking to invest your money? And, since you are speaking from the real estate side, do you think it's possible for a 22-year-old to reasonably be able to get into real estate?
Thank you for that. And just to ride on what my colleagues have spoken about, definitely would have done things a bit different. I think when I was around that age, my first investment was in equities, as Bansri has spoken about, and then I made some money there. I think that's when the bug bit, and from that on, I've been at it for a moment. But if I was to do things a bit different, I think to George's point, be to start off on the fixed income side, with the sole reason that you build up what is famously known as an emergency fund, or funds that are able to take care of your lifestyle. Because a number of times when I was doing the equities, had to disrupt the portfolio for you to take care of certain small things that have come up, because the disposable income is not too much and there's something you need to do. So it forces you to exit certain positions prematurely. So what probably I would have done different is that, so set up all those funds that I can always go into, the money market, the bonds, and whatever. Because if you had locked in a bond back in the day, and this cycle that we've gone through last year, I think 10 or 12 years ago, a similar thing happened. And I think that time bonds were closer to 20% or thereabouts. So it's because they are cycles, they're just market cycles. So it's if you miss the bus, you just need to be at the bus stop long enough, that bus will come back again. The only thing is you need to be able to jump on the next time it comes, and don't jump out because you have to disrupt that portfolio to handle some other nuisance somewhere else. So for me, that has been the key learning point over time, for you to really harness the power of compound interest. Because when you do the math or you set it out on a timeline, the doubling starts to have meaningful impact after 5, 7 years. That's when the numbers really start. Every time it doubles, it's a significant number. But when you're starting out, it's 1 shilling, 2 shillings, 4 shillings, 5. Then does it really make sense for somebody looking at it at that point in time? But when it gets to 1 million, then it's 2 million, then 4 million, which if had started by the time I was 22, be a completely different story. Because if you disrupt it at time t plus 1, t minus 1, the impact is so huge that the restarting then takes you a lot of time. So I think it's the order of investing rather than the asset classes are fine, but it's the order in which you do them is what I will have probably done. To your other question about real estate, again, it's perfectly possible if you have the basics, the survival element of things in check, so that you do not buy a unit or you do not start the process of buying a unit, then midway through, you have to then exit that particular transaction. Then it becomes very suboptimal. So if you have your emergency fund in check, you are okay, can survive 6 months. If you lost a job or you lost your primary source of income, it doesn't force you immediately to sell that unit or for you to move into that unit and therefore forgo the rental yield that you'll probably be making. Then first things first, just deal with the basics, then build onto that as you proceed. Yeah.
Okay, and quick follow-up on that. Rent to own. Is rent to own a thing? Is that something you can do with developers such as Vida? And do you think that is a reasonable route for a younger person who may not have excess liquidity to get into the real estate market?
It is possible, and different banks, the government, and some DFIs are trying to work something around that. The only reason why at the moment, or many developers have not been able to pull it off, is what I will term a structural problem of the economy, where the government is borrowing at such high interest rates that if I load up that interest on your monthly installment, it becomes even expensive than the rent you will have paid in that same unit. Because remember, when we started off talking about yields of between 6 to 10%, yet the government paper is at 8 and went to as high as 16. So if I have to account for that cost of capital, then that monthly installment that I will expect from you then ceases to make sense. Hence why the KMRC product was introduced, which brought those interest rates to sub 10, around 9.5%. And for some of our products, and I've seen certain instances where somebody has taken the KMRC loan and that mortgage installment is actually less than the rent on that unit, which means they actually end up owning that unit for only 10% of the value of the unit that they originally put in. And that is also dependent on the location and the rentals that are achievable. But at Garden City, I have a case study of where that has worked. And in all our projects, that's something that we are very keen on. And we are working with some local partners, banks, and financial institutions to structure such a product to be able to target the next segment of the market.
Okay, thank you for that. That's interesting. We'll have to talk off camera on that more. I'm really interested in the rent to own side of things. Now, Bansri, I know you have to go, but I do want to give you the first question in the Q&A before you run. So I have a question here from Akash Patel asking, what resources and websites are out there to know more about different types of investments accounts available here in Kenya? And then there's a second question. Do we have any tax sheltered accounts where the income generated does not attract tax liability? That's a great question because the finance bill was voted through its third reading today.
Thanks, Andrew. Very good question by Akash. So in terms of resources and website, I think in terms of the organic products like equities, bonds, derivatives, I think we do a lot of trainings on these products. A lot of information on the products are also on our website. That's the AIB-AXYS website. I think more than that, you'd get a much deeper pool of information if you were able to refer to the CMA website as well. I think they also have presentations put out for the specific products. They also have a lot of information on money market funds. They have quarterly bulletins on what funds, what the performance of the different funds is, what are the kind of, where investors should be putting out their money, and generally just where the appetite and the deviation from different products is moving towards in terms of just performance. So I think that's one of the resources. But I think through any of the capital markets players, whether it's a brokerage like ours, investment banks, we all have some sort of information, at least to give you that preliminary view and basics in terms of what is equities, what is bonds, what is derivatives, what is an offshore product, how do you start your investment journey. And I'm very, very happy, Akash, to take this offline with you and help you start this journey as well. So that's I would believe a starting point. And I mean, you could always visit most of us for more information. But in terms of if you want to quickly read something, our website, you can look at the CMA website, the NSE website. I think they provide a wealth of information, probably going to baffle you and probably going to confuse you at some point. So, but it's a good starting point, I would say, because there's a lot of information out there. Yes, in terms of the next question is, do we have any tax sheltered accounts? So, Akash, I can almost confirm we do not. I think the only sort of tax exempt investment that we have right now in the Kenyan market is the IFBs, the infrastructure bonds. And on those bonds, of course, there's no withholding tax deducted from the interest payments. But in terms of equities, for listed equities, the stamp duty, no CGT, and normal treasury bonds investments, of course, there's a 15% withholding tax deducted. So in one way or form, tax is deducted, but of course, from the listed side, you are exempt to a certain extent in terms of CGT. So yeah, that's, I would say in a nutshell from a tax perspective. Of course, we're always looking for more tax exemptions, but the one that is fully exempt from tax would be an infrastructure bond.
Yeah, and I think my comment on that for Akash is there's only two guaranteed things in life, death and taxes. So, but Bansri, thank you so much for your insight. Do you still need to run, or can you hang out for a few more minutes and tackle a few more questions with us?
Okay, Andrew, I did have a hard stop at 7, maybe a few more minutes.
Okay. Yeah, we have some really interesting questions up here. Thank you for everyone who is, adding questions here. So let me find a real good one. I think this is really interesting from Winnie. And she did send a correction. This is, when is the most favorable time period to purchase either T-bills or T-bonds? Whoever wants to tackle that can tackle that. I don't have an answer for that.
Okay. Thanks, Andrew. Maybe let me take a shot at it. So my advice would be the best time to buy would be as soon as possible, because the more you postpone, then if you are not currently invested in anything, then you are losing out on the income. I think one of the considerations would be, how long do you want to invest for? Is it just a short time where you can do 91-day T-bill, that's 3 months, all the way to 1 year? Or for a treasury bond, then do you want to buy it and hold it to maturity? Or are you willing to sell it at some point? So, and maybe I'm trying to read the question behind the question. But of course, if then you buy a long-term bond, especially as a retail investor, when it comes time to sell, then you might encounter a bit of a challenge, because the way our market is, there are a lot of trades which are happening for bonds, but they're usually for big ticket sizes. So you might find that you are offering your bond, which is a relatively low ticket size, but then you don't find so many takers. Of course, the solution for that is, to get into a structure where you, Winnie, Andrew, myself, and so on, combine our money so that we're able to buy these ticket sizes. And in a nutshell, then that is what unit trust funds are. Another name for unit trust funds actually collective investment schemes. Then, of course, you can go a step ahead and say that instead of just buying and holding, you can engage a professional who will be looking at all the T-bills and all the bonds, and then they can be able to do the buying and selling every day on your behalf, just to be sure that it's optimally invested. And they're actually asking themselves the very same question you've asked: when is it best to buy this 20-year bond? When is it best to sell this 2-year bond, and so on? So yes, it is possible as an individual to buy this bond. It might be a bit more involving, and of course, you would be expected to keep track of what is happening in the market if you want to sell, or you can be able to delegate these, to an expert of your choice. One of them being Britam Asset Managers, who will then be making those decisions based on a lot of investment research, going ahead and executing, on a daily basis, just to make sure that you are optimally invested. But when it comes to investments, don't postpone. You better get in now. All of us are human beings, Andrew, and we know if you leave home, with 5,000 shillings in your pocket, for some reason, the opportunities to spend that money will become very available on that trip, much more than, and much more noticeable than if you only had 100 shillings in your pocket. So unless you've already tied down some of your money as savings, and if I can digress a bit, if there's one thing which separates the people who are happy at retirement versus the people who are trying to, get that one big deal because they haven't put aside enough, it's how consistent they were in saving and investing. So today, if you earn 50,000, 100,000, however much you earn, the best decision you can make is to put something aside for saving and invest it before you even start spending. This is because once you start spending, as I said, you don't know where there are limited opportunities to spend, and you won't know how fast you have depleted your money. So put some money aside, invest it as soon as possible, just to forestall that temptation to be able to get this or that spending done, and then take that one step further. Try to engage a professional who will be doing the work for you, so that as you're sleeping, as you're waking up, your money is always working as hard as it can for you. Thank you.
Okay. Bansri, any final thoughts in regards to this question on bonds and bills?
Yes, I think Solomon has covered it quite well in terms of looking at the fundamental factors, but probably from my point of view, and what I would tell investors is I think the best time to buy a T-bill or T-bond is at primary issuance level, when they have just been, of course, once the T-bond or the T-bill has been announced, and it gives you good time to sort of take advantage of pricing. But it also doesn't allow all investors to participate as well. So, and that's why some of us are here, because you can always come back to the market. But like Solomon has said, immediately is better. So you can take advantage of all the price gains and price gains earlier on. So a primary issuance would be my advice to investors, and if not possible at that point, then immediately after, through brokers like myself who have access to the market and who can access those bonds for you as well. So yeah, anytime immediately the bond is announced or after.
Okay, awesome. We're seeing so many comments and questions come through. Thank you all for adding those. I want to go through a few more. Bansri, thank you so much for joining us.
Thanks, Andrew.
But yeah, we appreciated your insight so much. And guys, if you want to connect with Solomon, Bansri, George, we're accessible. Even if you reach out to the Kenyan Wall Street, we can put you in contact with the right people and get you the answers to those. But my next question now comes from Mr. Duncan Mutura, which, Solomon, I think this is probably the best for you. The issue with the off-plan real estate is that different companies taking your money and failing to deliver. How can customers protect themselves to ensure that they get their property at the end of the day?
Thank you, Andrew. And this has been an issue that has really plagued our market for a while, and it's a trust deficit between the developers and clients. I believe this market will have been far much bigger. The off-plan real estate segment will be so big if whatever has happened in the past wouldn't have happened. But those things that have happened have contributed or helped credible real estate developers to know the do's and don'ts and how to build that trust with their customers. So for us, I'll speak for Mivida specifically, is one, the track record and the credibility and the governance that comes with that we've built over time. And we are very open and transparent with all our buyers. Our sale process is very transparent. And we consistently invite our clients to site to come and see what is going on. And where we are not meeting our end of the bargain, we are always willing to sit down with our clients and discuss whatever issues. So far, we've not had any challenges. The business is very well capitalized. Our governance is top notch. We hold ourselves to similar governance levels as would be expected of any blue chip or corporate or listed entity. And we still hold those ambitions of one day turning Mivida into one of the listed entities in this market, just to give that confidence to our buyers and our customers. And those who've been with us for the last couple of years can attest to it. And our projects are all very well ahead of schedule. And in the next couple of weeks or days, you will see a lot of advertisements and us calling buyers who bought some of our products to come and take possession of some of those units, which goes a long way in building that track record. So it's a question of who are you choosing to partner with in this journey of real estate, and how open are they with you and transparent and credible with you. I will always encourage any person to carry out their due diligence before handing over their money to any developer. And if there are any red flags, it's always very important to trust your instinct, because with some people it's never as it seems. Feel free to ask as many questions. Come to site, see whatever you need to see. Come to our offices. Our offices are at Garden City Business Park on the first floor. So we have a physical presence. We manage the entire Garden City. So we are here to stay.
Yeah, I think that's great advice. Is, really it comes down to choosing the right developer, and don't even think of it as buying from a developer. Think of, Mivida and others, as your partners in this journey. I think that's a really important, aspect that really can help change your mindset as well. You want to partner with the right people. You want to, marry the right person, things like that. It's about doing your due diligence and making sure you pick the right people. And as a media company, you hear about developers who are, defaulting and such, on different projects or have taken money. I mean, the Kenyan Wall Street is here. We want to raise awareness and make sure that, brands such as Mavida and others who have done really good work, are getting the spotlight and not those who are causing issues for investors. Now, I have another question here from Carlos Owondi. Then he says, anyone can answer. So I'm new to these investing practices, and I had a question on starting. If I were to start investing via an MMF, do I need a constant cash flow, or can I just be depositing whenever? George, do you want to take this one? I think this is well within your wheelhouse.
Yeah, okay, thank you. Yes, I can be able to take it. So for anyone who is new to investing, actually investing in a money market fund would be one of the best places you can be able to start at. The fund themselves, they are quite easy to join, and the concept of a money market fund, I think, is straightforward. So the question about whether someone needs a constant cash flow, the straight answer is no. So long as you meet the minimum investment amount of 1,000 shillings, then you can be able to top up anytime you want and anytime you have some cash available. As an investment professional, my advice would be the more consistent you are in topping up, the better, both for building up your savings, building up your investment portfolio. And of course, that sort of discipline will help you very much, especially when you have, quote unquote, a rainy day. So if you only have 1,000 in disposable income, you can be able to join our money market fund. Anytime you have anything else you can be able to top up with, you can be able to bring that in, but there is no requirement that you have to keep on topping up. It is just advisable so that when you have a bit of a problem, let's say somewhere down the line, you want to purchase something, or you're a bit low on cash flow, then your nest egg is a bit bigger than just the 1,000 shilling that you started with.
Okay. Yeah, I think that's really good advice. Growing up, what my parents always told me was, when you get your paycheck, pay yourself first. And what they meant by that was, invest the money immediately. Don't let it sit in your account, because that temptation, like we said earlier, to go walking around town and be like, oh, I'm gonna stop in Java and get a coffee. I'm go get a balozi over here. It can be tempting. So, I think that's really good. And the consistency piece is important, in becoming just a professional individual. Habits are incredibly important. And I think in your investment journey, having strong habits is very, very important. Solomon, I actually met someone who, lives here in Nairobi, but they get a very considerable bonus check, each year. And what they told me was, hey, a lot of people go out and they spend their bonus checks really quickly. And this is like over $1 million shilling bonus check in December. They said, I built the habit of, I go out and, I'll buy an investment apartment, or I'll buy, I'll find a way, to build that to where over the years, if you work for this company for 10 years, you may have started at 0, but later on you've built that habit of, hey, I'm not going to go blow all of this in Zanzibar. I'm going to, plan for my future, my children's future, etc. Now, I want to take 2 more questions because I know we're a bit over time, and it's almost 7:30. But thank you to the well over 1,100 people who have joined us tonight. This is absolutely spectacular. We're very excited you joined us, and we hope you got something out of this. Of course, you can reach out to Britam, you can reach out to Mavida, and such. But for, industry insights and such, please follow the Kenyan Wall Street. I won't charge you a paywall to read our website. So, we want to make sure information is accessible to everyone. Now, my next question here comes from Mr. Charles Humphrey. Question back at Solomon. Based on your analysis and information of the diverse real estate market in Kenya, which specific category of real estate has shown to be the most profitable and with stable appreciating trends, which are predicted to remain constant? So I'm assuming this question is around, what type of real estate tends to be the best?
It's a tough question, and will have different diverse answers depending on someone's risk appetite and the capital or horizon they're willing to put down. From where I sit, I will say on the residential side, because of its resilience, and importantly in well master planned developments, where you somehow have control over what is going to happen on the neighboring areas, because that is what tends to dilute those returns. If somebody else comes and puts up either a very tall building and covers you, so you no longer have the light you used to have before, or puts up a building that is not pleasant and therefore kills the views, and that attractive feature of that then disappears, which means your future tenants are no longer willing to pay that particular premium they used to. But in well master plan developments, which is what we do, that's what the promise we are giving to our investors, that in this 10, 20, 30 acre parcel of land, this is how, after all is said and done, this is how it will look like. And you are guaranteed that there's nothing that's going to disrupt your views. If it's your greenery, your landscaping, and what have you, all that is there. And that can be attested. If you visit any of our sites, you'll be able to experience that green, that lush, that very well organized development. What that then does is it preserves the capital, and it preserves the value and the overall appeal of that area. And as time progresses, and as the land in Nairobi, because it's a finite piece of land, and as the population increases, such beautiful estates will get lost, which means you will have preserved your value and capital over the long haul, which means over time, every next generation will be willing to pay a small premium to be able to live in that particular area. It's the same thing we're experiencing right now. Everybody who makes their money wants to go live in Karen. Why? Because they protected the development 30, 40 years ago. So it's the same thing we're trying to do. And with that, we've seen very consistent and stable returns for the investors who've chosen to invest with us, especially at our flagship project at Garden City and in other master planned developments within Nairobi, the tattoo cities of this world that are coming up. So that's what I would say at this particular point. Of course, in investments and in finance, and George will attest to this, is that the past is not really a predictor of what will happen in the future. It is an indicator, but not a guarantee. So I cannot really guarantee you that that's what is going to play out in the long run. But with all the information that we have today, that tends to be the bet that has the highest probability of winning.
Okay, and I guess personal anecdote from my side. When I first moved to Kenya, I got a nice apartment in Kileleshwa. I used to be able to see the whole town. It was gorgeous. Now I got a bunch of concrete, blocking the way. And so now I'm sitting here saying, gosh, how do I get to Ridgeways? How do I get to Runda? How do I get off of this chaos? And even the street used to have trees. And then one day KPLC decided to butcher them all. So I agree with you on kind of the master planned development side. kind of the concept also of estates as well. There's a bit more control over the environment. It's a bit more longer term as opposed to, getting an apartment where someone can build, half another building half a meter away from your balcony. You don't want to spend 15 million shillings on, 3-bedroom apartment, and 3 years later, no one's willing to even pay $1 million for it because there's no view, there's no airflow, and such. So I'm with you 100% on that. I've learned my lesson on that.
Come to the Vida side of life.
Absolutely. We'll have to talk. Now, I said I want to take one more question. And this question's a bit different from all the other ones we've addressed. I want to start with George on it, then we can go to Solomon, and we'll wrap up here so that we don't take everyone's evening away from them. Now, this question comes from Alex. He says, are there facilities that can make it easier for a Ugandan to invest in Kenyan financial assets?
Thanks, Alex, for that question. And the simple answer is yes. There are facilities, there are investment products that you can invest in as a Ugandan citizen. I think for most of the session today, we've been talking about, especially on the financial asset side, unit trust funds, collective investment schemes, money market funds, and so on. And the good news is that these are not restricted to just Kenyans. You can come in as a Ugandan and invest in a money market fund just the same way that a Kenyan would. And you can invest in the Bond Plus fund, you can invest in a dollar fixed income fund just the same way a Kenyan would. The CMA, I think, has been quite forward-looking in terms of making our market a bit liberalized. And of course, that is good because the more investors we attract, then the deeper our market becomes. So, Alex, please come on. You can contact Britam, you can contact us to be able to see which fund is most appropriate for you. And very quickly, because you said that this is the final response, Andrew, maybe I can add on to that for question from Alex. Is that earlier we had talked about compound interest. As Andrew had said, it's one of the most magnificent things you can be able to get. For Britam Asset Managers products such as our money market fund, we actually have daily compounding. And what that simply means is that the interest you earned yesterday will be credited to your account today, and now that interest in itself will start earning you more because it will have formed part of the principal. So, Alex, I hope that is enough enticement to come to the unit trust funds and the money market fund investment product, even as a Ugandan. Thanks.
Solomon, can a Ugandan invest at Mavida?
Definitely, and we have a number who've already invested with us. On the real estate side, the only thing that then they will need to get is just a KRA PIN for purposes of the conveyancing element, which you will require that unless there are other structures you could take up. Just set up an entity in Kenya. And then use that entity or special purpose vehicle for purposes of that. The lawyers and the tax advisors are very open to that. So the legislation, the way it's set up, allows for foreign investments into the country, and we have quite a number. And you can always reach out to us, and we can suggest to you some tax efficient ways of being able to achieve that. Yeah.
Awesome. Awesome. Now, I said that was going to be the final question, but my final question is for you, you guys. So tell me, and we'll start with George and we'll allow Solomon to give the final thoughts. Is there anything, if I'm just now tuning in to this discussion, what is the one thing I need to take away from it?
All right. Thanks, Andrew. So if you have just joined, the one thing you need to take away is you need to understand your objectives, and you need to know what investment risk is. Investment risk is how variable are the returns you're likely to get from a certain investment product. And one of the ways of reducing investment risk is, of course, investing with reputable professionals. Then, if I can just add something which has just occurred to me about compound interests. Again, it might sound like it's a complex concept, but I think most of us are familiar with livestock. So just assume you have some livestock, let's say one sheep. So if that sheep then in terms of quote unquote return, then gives you, one kid, then that is just a direct return, okay? But now, if the kid which you got from the sheep itself also gets another kid, then that is compounded return. And if you can imagine, if you start with one sheep, then at the end of the year, you have probably 2 or 3. But then the next year, each of them, give birth to either 1 or 2. At the end of 2 or 3 years, you'll have a very huge and large flock. And that, in a nutshell, is what compounding of interest is whatever interest you earn in itself also starts earning. So please look out for products such as money market funds, which have compounded interest. Thank you.
Solomon, any final thoughts for us today? If I'm just now tuning in, what do I need to know?
I will just echo what George has said and ride on that. And what we'll just add on to it is about consistency in the whole investment journey. And never tire of speaking about the importance of diversifying your portfolio, because then that diversification is what helps you get through the rough patches, so you don't disrupt the impact of compounding. So to George's example, if you are now about to double your flock from the 1 to about to get to 100, which means just before that they were around 50, and that at that particular time you have to sell some to pay for school fees. It means you've really disrupted all the good work that you had done. But if you had another portfolio or another investment somewhere else that you're able to tap into and pay your fee and let your flock continue doubling, the impact of that in a few years is extremely monumental. So I'll just summarize by encouraging everyone to just be consistent in the journey and to diversify and to understand that the different asset classes serve different purposes in the overall portfolio.
Awesome. Solomon, George, and also to Bansri, thank you guys so much for joining me this evening. I know we've run over about 30 minutes, but it's a good discussion and we have over 1,200 people listening. So, that's really good. And to everyone listening in, my final thought, maybe this is a little self-serving, but you need to stay up to date on what's happening. And you can do that by following the Kenyan Wall Street. As I mentioned earlier, there's no paywall on our website, so you don't have to pay to get good insights. And the Kenyan Wall Street is located here at the Nairobi Securities Exchange in Westlands. So if you're wondering who has some of the best market insights, on different developing things that impact investors, business people, please come to the Kenyan Wall Street. You can follow us on any social media channel or at our website. And if you want to reach out to George or Solomon or Bansri, you can go to their websites. I'm sure they all have, forms you can fill out, and someone will reach out to you very quickly. Whether you're looking to, buy an apartment or 15 apartments, or if you're looking to start your MMF journey, you can reach out to Britam. Or if you're interested in, looking at trading both Kenyan and foreign equities, you can reach out to AIB-AXYS. So thank you all again for joining me. To everyone tuning in, thank you so much, and have a lovely evening.
Thank you. Thank you very much, and thank you for your time.
Thank you, Andrew. Thank you, everyone. I think we should do this more often.
Definitely.
We shall.
Thank you.